Welcome back to Indianomics. We are discussing the bunch of reforms announced for the bond markets last week by the Reserve Bank and whether this permanently puts the bond market in a healthy shape and makes it a vibrant market. Well, first up, what is the link between the corporate bond market, or rather the debt market, and the lending bank lending itself? Can they talk to each other? That really is the problem in India. And Mr. Khan, what's your take on this? Today there is no term money market, no connection between, say, the debt markets and the banks setting the lending rate. They do it according to their deposit cost. Do you see any steps from RBI to ensure that these two markets talk to each other so that, loans are priced according to the debt market?
Let me put a bit of a context to this. It's always, cart before the horse, or egg and chicken and egg type of situation, which should come first. No, one major area where corporate bond market requires a driver is market making. So market making, who will do the market making in corporate bond? Banks are already buying. PDs have been allowed quite a bit of leeway, but they have their limitation because their major responsibility is GSEC part. And in the press release we have, in fact, this another major game changer is that for a long time we are waiting for this market making in government bonds for the PDs. So some framework has been now agreed upon. So now government and RBI is what that is going to put. But for the corporate debt, really the PDs cannot go that extent. So there are brokers who can do it, but they need some liquidity and funding support. So now they will be allowed repo in market repo access in the corporate bond paper. So that is step number one. Then the other thing is we have mentioned about tripartite repo, because that is also another part which will expedite. And next in the line will be the acceptance of corporate bond under RBI's LAF window. So that could be the sequence. But if you talk about LAF, RBI LAF, we have to see it slightly in a overall perspective. There are positives, there are risks involved. Positive is that it will provide a funding support. Liquidity will be added. Then RBI has another asset class. So, and you give a nudge to this whole market directly and indirectly. But the negative part, as some of the commentators have mentioned, that we carry the credit risk and we will only be focusing AA or AAA and again segmenting the market. Third is, after doing all that, market doesn't take up, then reputation risk. But then at some point of time one has to take a bit of a risk and take it forward. That's why we have suggested that to start with we can probably do it for overnight basis, maybe for AAA, AA paper, and with some adequate haircut. So this is something, an enabling thing which will provide some sort of a nudge to the market. That's the background.
Actually, I'm told we are running out of time, so very quickly, do you think infrastructure projects will get money? I mean, if you have a 25,000 crore UMPP, how will it get funded in 2018, 2019?
See, one thing we should appreciate is that the corporate bond market we have today, and at least in the slightly medium term, 2-3 years, is still going to continue to be a high grade market, which is still a AAA, AA market.
Exactly.
And that is unlikely to change unless you have huge amounts of high yield sort of money coming into funds, which I don't think is the focus of even the funds either. So right now I think fixed income is an asset class which is marketed as something you get an yield pickup over sovereign, and it is safe and secure, and therefore there's no credit risk there. So this is a high grade market. So if you're looking at project financing being achieved through capital markets, I think the partial credit enhancement route is the only way to go, and that is something which is extremely positive. But whether even on a plain project finance with the credit enhancement you'll have a market which takes off, we'll have to see. But the partial credit enhancement which has been allowed right now, I think is an extremely useful tool in terms of allowing access to corporates who otherwise will not be high grade. And I think that is extremely positive. Just to answer the other question in terms of loans versus bonds, right? I think the biggest thing for corporates today is that if you're borrowing 10-year money or 5-year money, irrespective of the level of interest rates, I don't think so a corporate is keen to lock into a single rate. Whereas a bank, it continues to be floating, and the bank product offers a lot more flexibility in terms of prepayment, pricing, whatever. You have huge amounts of flexibility there. So even if you look at the best of corporates, if they are doing project finance or if they are doing long-dated financing, I think locking into a fixed rate is not going to be easy for them. So unless you have the other markets available for them to swap back into floating in some form, I think it's still some work to get done on that front.
Okay. I thought you would mention there the demand problem. You know, IRDA and other PFRDA have to perhaps lower their standards. Now, that is my last question because we're out of time. Hitendra, it is ideal to ask, like, who will buy the infrastructure paper? It should be the PFRDA. But you know, all of us, I think, in probably 10 years' time, will be wanting our pension money. Will you be happy if our pension funds are locked in infrastructure bonds, given the state of the legal system?
No, I think I would like to think that once you have supply, will it create its own demand? See, we have seen bonds issued as recent as just last month at coupons of between 9 to 10%, and the response has been overwhelming. So I think this is largely from retail and high net worth individuals. So I think, you know, I don't know a project which is rated, let's say, A or even BBB, and if it comes with a coupon of, let's say in the current context might be 12% or so, whether that generates its own demand. And if that is partially guaranteed by a bank and therefore it's got to a rating where it's double-digit coupons in the current interest rate context I'm talking, how much money has not come because the pricing has not been available. My own sense is that I think given what's happened to, you know, the inflows of money into equities, inflows of money into credit funds, inflows of money into income funds, etc., I think increasingly even the Indian saver is quite open to taking risk, but almost so far we've not even been allowed to take that risk. So it's again, as Mr. Khan said, it's a bit of a chicken and egg situation. So once the assets are available, and which is what RBI has mentioned, that, you know, we are creating the supply, we are creating the infrastructure, and the assumption is that the demand will follow. And I think beyond this, I'm not very sure what else as a market we can ask for. And I think this is quite good in that sense.
I believe the Reserve Bank has done its level best to push under the circumstances. But my fear is that unless we get our legal piece right, this corporate bond market cannot go beyond a point, cannot go. I mean, and actually, let me ask Mr. Khan that, since you've already retired, Mr. Khan, will you put your pension money into any of the infrastructure bonds? Until the legal piece is right, can this corporate bond market really take off like it should?
No, again, chicken and egg conundrum. So they have justifiable apprehension about credit quality, defaults and all that. So once you have a more and more liquid market, a robust market, so that apprehensions will come down. Similarly for CDS, in all matured market, the long-term players like insurance companies, they are the CDS sellers. They are because they are the long-term, they know that long-term space. But here, because the market has not developed, so they have the apprehension. So they have their points. So we need to work on that. Once the market develops, they will probably have little more comfort to be little more relaxed.
Okay. Unfortunately, out of time, but clearly from the two market experts, it's a thumbs up for Mr. Khan's report, as well as to the extent to which the Reserve Bank has pushed. Now the big date will be when the Reserve Bank Act is amended and corporate bonds, AAA or probably even AA, according to Mr. Khan, will be accepted with appropriate haircuts, and we could have a bank and a bond market to finance. Probably that level of maturity is just round the corner. We will have this discussion probably in a month or two when that amendment happens. Thank you very much for watching this edition of Indianomics.